Carol spent 34 years as a high school principal. She was methodical. She kept files on everything. When she retired at 67, she had 3 IRAs, a 403B from her district, and a brokerage account she had been building since 1991. She had done everything right. She maxed her contributions every year she could. She reinvested her dividends. She never touched the accounts during the years her salary was enough. At 74, Carol received a letter from the IRS proposing an excise tax of $14,200. She had taken her RMDs every year. She had the records. She had the receipts. She had done exactly what her financial advisor told her to do. The problem was that her advisor had been calculating her RMDs the wrong way for 3 years, not fraudulently, not carelessly, simply using the wrong table for her specific situation, one table instead of another, a single line on a worksheet that nobody ever checked. Carol had not done anything wrong in retirement that she had not done correctly for decades as a saver. The problem was that the RMD rules are more specific than almost anyone explains, and the gap between what most retirees think they know about RMDs and what the IRS actually requires is exactly where the excise tax lives. Today I'm going to walk you through the single most common RMD mistake that is costing retirees thousands of dollars in excise taxes every year, not because they are careless, because the rule has layers that the basic explanation leaves out entirely. There is a specific form, a specific deadline, a specific table, and a specific aggregation rule that most retirees have never been told about, and the IRS does not send a warning before it sends a bill. The first thing you need to understand is what an RMD actually is and why the IRS created it. When you put money into a traditional IRA or a 401k or a 403b, you got a tax deduction on the way in. The IRS let you defer the tax, but the IRS never forgave the tax. It only delayed it. The required minimum distribution rules are how the IRS collects what it has been waiting for. Starting at a specific age, the government requires you to withdraw a minimum amount from your pre-tax retirement accounts every year. That withdrawal is taxable income. If you do not take it, the IRS charges an excise tax on the amount you should have taken but did not. Under the Secure 2.0 Act, the age at which RMDs begin depends on when you were born. If you were born between 1951 and 1959, your required beginning date is April 1st of the year after you turn 73. If you were born in 1960 or later, that age is 75. For anyone already taking RMDs before these changes, the rules did not reset. You continue under the age that applied when you started. The excise tax for a missed or short RMD is 25% of the shortfall. Under Secure 2.0, that penalty drops to 10% if you correct the mistake within 2 years by taking the missed amount and filing Form 5329 with the IRS. That reduction matters. But 10% of a large shortfall on a large account is still a significant number, and the retirees who get hit by it almost never saw it coming. The second thing you need to understand is how the RMD is calculated, because this is where the mistake begins. The formula is simple on the surface. You take the account balance as of December 31st of the prior year, you divide it by a life expectancy factor from an IRS table. The result is the minimum amount you must withdraw that year. The formula is not complicated. What is complicated is which table you use and whether you are applying it to the right accounts in the right way. The IRS publishes 3 life expectancy tables in Publication 590B. The Uniform Lifetime Table is the one most retirees use. The Joint Life and Last Survivor Expectancy Table applies when your sole beneficiary is a spouse who is more than 10 years younger than you. The Single Life Expectancy Table applies to inherited IRAs and to certain beneficiary calculations. Most retirees use the Uniform Lifetime Table correctly, but a meaningful number of retirees who qualify for the Joint Life Table are using the Uniform Lifetime Table instead. And that single error means they are taking out more than required, which sounds like a small problem until you realize the compounding effect on their account balance, their tax bracket, and their Medicare premiums over a decade. The more dangerous error runs the other direction. Retirees who should be using the Uniform Lifetime Table but apply an outdated version of it. The IRS updated its life expectancy tables in 2022. The new tables have longer life expectancy factors, which means the divisors are larger, which means the required withdrawal amounts are smaller. A retiree using the pre-2022 tables is withdrawing more than required, not less. That is not an IRS problem, but a retiree using outdated factors in a spreadsheet or an old calculator and withdrawing less than the updated table now requires is creating an underpayment. The IRS updated the tables. The retiree did not update the spreadsheet. The excise tax does not care why. Let me put a real dollar amount on this so it is not abstract. Patricia is 76 years old. She has a single traditional IRA with a December 31st balance of $620,000. Her sole beneficiary is her husband, who is 14 years younger than she is. Using the Uniform Lifetime Table, her distribution period at age 76 is 23.7 years. Her RMD is $26,160. But because her spouse is more than 10 years younger and is her sole beneficiary, she qualifies to use the Joint Life and Last Survivor Table. At her age and her husband's age, the joint life factor is 31.2. Her actual RMD is $19,872. If Patricia uses the wrong table, she withdraws $26,160 when she only needed to withdraw $19,172. She pays income tax on $6,288 she was not required to distribute. At a 22% marginal rate, that is $1,183 in unnecessary tax in a single year. Over 5 years, compounding with account growth, the cumulative unnecessary tax easily exceeds $8,000. No penalty, no fraud, just the wrong table applied by someone who did not know there was a different table for her situation. The third thing that changes is the aggregation rule. And this is the one that catches organized, detail-oriented retirees who think they are handling RMDs correctly because they are taking a distribution from each account every year. The aggregation rule is specific and it is misunderstood. For traditional IRAs, including SEP IRAs and simple IRAs, you calculate the RMD separately for each account, but you are permitted to take the total combined RMD from any one or any combination of your IRA accounts. The total amount withdrawn must equal or exceed the sum of all individual account RMDs. You do not have to take a separate distribution from each IRA. You can satisfy the entire IRA RMD obligation from a single IRA. For 401k and 403b accounts, the rule is different. Each employer plan RMD must be taken from that specific plan. You cannot use an IRA distribution to satisfy a 401k RMD. You cannot aggregate across employer plan types. If you have a 401k from a former employer and a 403b from a school district and a traditional IRA, you have 3 separate RMD obligations calculated independently. The IRA RMD can be satisfied from any IRA. The 401k RMD must come from that 401k. The 403b RMD must come from that 403b. The retiree who takes all of their withdrawals from their IRA and forgets that the 401k they never rolled over still has its own RMD requirement will receive a notice proposing a 25% excise tax on the missed 401k RMD. The IRS knows the balance was there. The custodian reported it. The distribution did not happen. The excise tax applies to the full shortfall, regardless of how much the retiree withdrew from other accounts. If this is helping you understand what you need to set up correctly before your next RMD deadline, hit the like button right now and share this with any retiree you know who has more than one retirement account. Subscribe and turn on the bell so you never miss a video like this one. The fourth issue is the first-year rule and the April 1st trap. When you reach your required beginning age, you are allowed to delay your very first RMD until April 1st of the following year. This is the required beginning date provision. It sounds like a gift. For many retirees, it becomes a mistake because if you delay your first RMD to April 1st, you still owe your second RMD by December 31st of that same year. 2 RMDs in 1 calendar year. Both are fully taxable. Both count toward your combined income for that year. Both affect your Medicare RMD calculation 2 years later. Both can push you into a higher tax bracket for the year in which they land. A retiree who delays their first RMD to take advantage of the April 1st rule without modeling what 2 distributions in 1 year does to their tax liability is making a decision based on incomplete information. In some cases, delaying is the right call. In other cases, taking the first RMD in the year you turn 73 or 75, even though you are not required to, is the move that costs less in total tax. The math depends on your income in both years, but the retiree who delays simply because they were told they could, without running the numbers, is rolling the dice on their tax bracket. Let me give you a specific example. George turns 73 in 2026. His RMD for 2026 is $22,400. He delays it to April 1st, 2027. His RMD for 2027, calculated on the December 31st, 2026 balance, is $23,100. In 2027, George takes both distributions. His combined RMD income for 2027 is $45,500. Added to his Social Security and pension, his 2027 income pushes him into the 22% bracket when he would have been in the 12% bracket. The extra tax cost from the bracket increase is roughly $2,300. The delay cost him money. If George had taken the 2026 RMD in 2026 when his income was lower, he would have paid tax at 12% on that distribution. 1 year of waiting flipped the economics entirely. The fifth issue is inherited IRAs, and the rules here changed dramatically in 2020 under the Secure Act and again under proposed and finalized IRS regulations that followed. If you inherited an IRA from someone who was not your spouse, the rules that used to apply, the stretch IRA rules that allowed you to take small distributions over your own lifetime, are largely gone. Most non-spouse beneficiaries who inherited after January 1st, 2020 are now subject to the 10-year rule. The entire inherited IRA balance must be distributed by December 31st of the 10th year following the year of the original owner's death. That is the outside deadline. It is not a distribution schedule. It is a final deadline. The confusion came from a long period of regulatory uncertainty about whether annual RMDs were required within that 10-year window or whether you could simply leave the account alone and take everything in year 10. The IRS finalized its position in 2024. For inherited IRAs, where the original owner had already reached their required beginning date before death, non-spouse beneficiaries who are subject to the 10-year rule must also take annual RMDs during years 1 through 9. In addition to clearing the account by year 10, the annual RMD amount is calculated using the single life expectancy table based on the beneficiary's age in the year following the year of death. A retiree who inherited a parent's IRA in 2021 assumed the 10-year rule meant they could wait until 2031 to take everything, and has taken nothing in years 1 through 4 is potentially sitting on 4 years of missed annual RMDs. The IRS waived penalties for missed RMDs and inherited IRAs for 2021 through 2024. Those waivers ended. Starting with the 2025 distribution year, the excise tax applies. The retiree who did not know the annual requirement was real is now facing a calculation of 4 years of shortfall, plus the ongoing annual obligation for years 5 through 9. This is not a fringe situation. Millions of Americans inherited IRAs from parents who passed during the COVID years. Most of them received a brief explanation of the 10-year rule and nothing further. The nuance about annual distributions within the 10-year window was never explained, and the IRS penalty notices are starting to arrive. Here is your action checklist. On the RMD table question, open publication 590B right now and look at the 3 tables. If your sole IRA beneficiary is a spouse more than 10 years younger than you qualify for the joint life table, and you should verify that every RMD calculation you have done in the last 3 years used it. If you are using a spreadsheet or a calculator from before 2022, replace it. The IRS updated the tables effective January 1st, 2022. Any calculation using pre-2022 factors is wrong. On the aggregation rule, make a list of every retirement account you own. Separate it into 2 categories. Traditional IRAs, SEP IRAs, and simple IRAs go in one group. Employer plans, 401k, 403b, 457b go in a separate group. Calculate the RMD for each account in each group independently. The IRA group can be satisfied with a combined distribution from any IRA. Each employer plan RMD must be satisfied from that specific plan. If you have an old 401k you never rolled over, call that plan administrator this week and confirm the RMD status. On the first year April 1st decision, do not delay your first RMD without modeling your income in both the year you delay and the year 2 distributions land. The calculation is not complicated. Add your projected income without the RMD in year 1. Add your projected income with 2 RMDs in year 2. Compare the tax owed in each scenario. The answer will tell you whether delaying helps or hurts you specifically. On inherited IRAs, if you inherited a traditional IRA from a non-spouse after January 1st, 2020, and the original owner had already reached their required beginning date, you owe annual RMDs in years 1 through 9. The 2025 distribution year is the first year the excise tax fully applies. If you have missed years, file Form 5329 for each missed year and take the corrected distributions. The reduced 10% penalty under Secure 2.0 applies if you correct within 2 years. Now, let me connect all of this to the bigger picture. The IRS is not the only system affected by your RMD decisions. Every dollar you take as an RMD is ordinary income that lands on line 4B of your Form 1040. It raises your adjusted gross income. A higher AGI means more of your Social Security benefit is taxable. It means your Medicare Part B and Part D premiums may increase through the IRMA surcharge based on your income 2 years ago. A retiree who took 2 RMDs in 1 year because of the April 1st delay may see their Medicare premiums spike 2 years later, long after they have forgotten why their income was elevated that year. The tax return from 2026 sets your Medicare premiums for 2028. Every RMD decision has a 2-year shadow. The retiree who correctly calculates the RMD, takes it from the right account, uses the right table, and times it in the right year is not just avoiding the excise tax. They are managing their AGI, their Social Security taxation threshold, and their Medicare costs simultaneously. The RMD is not one decision, it is 4 decisions layered on top of each other, and most retirees are making one of them correctly and missing the other 3. Let me tell you about David. He is 74. He retired at 65 with a 401k from his primary employer, a rollover IRA from an earlier job he never consolidated, and a small 403b from a part-time teaching position he held for 6 years in his 50s. He is organized. He uses a spreadsheet. He has been taking his RMDs every year without a single missed deadline. His first problem was the 403b. He had forgotten it existed. The balance was only $38,000. His financial advisor managed the rollover IRA and the 401k and calculated RMDs for both. The 403b sat with the original plan administrator. Nobody was calculating the RMD on that account. When David received a CP2000 notice, the proposed excise tax was based on 3 years of missed 403b RMDs totaling $6,400 in undistributed funds. The penalty before the Secure 2.0 correction was $1,600. He corrected it within 2 years and paid the reduced 10% rate, but he spent 11 weeks resolving a problem that originated from one account he had simply stopped thinking about. His second problem was the table. His wife is 17 years younger than he is. He had been using the uniform lifetime table for 6 years. When his accountant caught the error during a review, the recalculation showed he had been taking approximately $4,100 more per year than required. Over 6 years, he had paid income tax on $24,600 he was never required to distribute. That money was gone. There is no way to put an excess distribution back into a pre-tax account. The unnecessary tax on those distributions, at his marginal rate, exceeded $5,400. Not a penalty, not a notice, just money paid to the IRS because nobody told him there was a different table for his situation. None of it was fraud, none of it was carelessness. All of it was the predictable result of a system that gives retirees a summary of the rules and calls it sufficient. David spent his career making good decisions with money. The system failed him by not explaining that the rules have versions and that the version you use matters as much as the rule itself. Here is the practical tip that saves most retirees significant stress and real money. In November of every year, before the December 31st RMD deadline, do a complete RMD audit. List every account, note the December 31st balance from the prior year, apply the correct table for each account, confirm the distribution from each employer plan was taken from that plan specifically. Confirm the total IRA distributions meet or exceed the combined IRA RMD. If you have an inherited IRA, recalculate the annual requirement separately. Check whether you are in a year where 2 RMDs might land. And if your income is running higher than expected, model the RMD threshold for your Medicare premium 2 years out. Experienced retirees treat the November RMD audit the way experienced employees treated their W-4 review. Once a year, systematically, before the deadline, with the right numbers in front of them. The retirees who do this never get the excise tax notice. The ones who skip it are the ones calling their accountant in January trying to figure out what went wrong.